Hey everybody, welcome back to Matt Money. Hope you're having a great start to the week. Things have been a little bit volatile here. Everybody that's been watching the market knows that obviously yesterday we were down around 7%, and today we are up around 5%. So just like last week, it's volatile up and down depending on the day, which is fine. Kind of want to look at the overall portfolio value, which I haven't really shown you guys over the past few weeks since the market's been a little bit volatile. And then I want to walk into the amount of stock that I've purchased into the portfolio here and kind of show you step by step which ones I bought and where they fit in and what kind of income I should be generating from those positions. Now, if you guys are hearing that my voice is a little bit hoarse, yes, sore throat a little bit, not exactly too sure what's going on here. But that being said, should be a good review, and we'll get right into it after this intro. All right, guys, so welcome back. So by this point, I'm probably zooming in the upper left-hand corner here. So to give you guys a brief overview of the total numbers before we really get into the breakdowns, and then eventually get into the stocks that I purchased and probably will continue to purchase for all of March of 2020. We'll zoom in this upper left-hand corner here. So the dividend portfolio is down to about $246,000 in combination with the 401k, which is around 128. There was like 128 and change as of end of close yesterday on Monday. I'm not going to wait for the couple hours that it takes for it to refresh. It's probably back into the 130s in my 401k, just based on the fact that we had 5% growth. In fact, maybe it's a little bit more. Maybe it's around 131, 132. That's fine. But the portfolio in total, combining those two, is around $374,000. That's down about $44,000 from the maximum. I remember seeing it get up to around 418,000, so it might have been 419,000, might have been 416 and some change, but I remember around that number. So we're overall down around $40,000 in the portfolio, which is fine with me. I mean, if you were to think about that as all-time highs, it's a little bit over 10%, which is perfectly fine for me. I have things in cash, I have things in energy, I have things in financials, so it is what it is. It's part of the dividend investing journey. But the cool thing is, what you've seen is, I'll scroll down a little bit, is the income continues to grow in the portfolio. So that's what I'm going after. I'm going after basically the underlying income that's supposed to come from the portfolio that allow me to really do whatever I want. So now we're almost up to $13,000 in the portfolio, which is pretty astonishing because it just felt like 2 weeks ago I was below the $12,000 a year mark. And I'll show you exactly what I purchased to kind of get me up to this point relatively quickly over the past few weeks to get me here. So pretty astonishing how the portfolio is really continuing to grow. Dividend yield at the moment is around 5.3-ish%, which is actually higher than the yield on cost. That's because I've been investing continuously over the past couple years. So some of the cost basis that I have now is actually down. So a lot of my energy positions are down. We'll get into a little bit about that as well. But I think that is relatively temporary and short term. And so I'm continuing to purchase stocks at the moment to continue to get this yield on cost a little bit up at the moment to try to match it closer to this overall dividend yield of the portfolio at the moment. It was around 4.8 or so the other day. So the fact that we're yield on cost is kind of creeping up a little bit again means that I'm buying stocks at really good yields. Whether or not they are in some sort of jeopardy to potentially cut the dividends or anything like that, I feel relatively confident that that's not going to happen. I've bought some really high quality companies, so I'm not bottom feeding off of companies that are trying to pay a 20% dividend yield or anything like that, where they don't really have a sustainable cash flow and can't support that. I'm trying to find good companies that the market just has kind of come out of favor for the last week or two to really try to pick up good companies at good prices. And so I fully anticipate that some of these positions, like the Wells Fargo and USBs of the world, which we'll kind of get into a little bit later, are down about 40% at the moment, which is pretty astonishing if you look at it that way. And the whole market as a whole was down around 20% as of yesterday. And the fact that we're back all the way up to just under 15% correction, but you still have some of these stocks that are 40% down, like your U.S. Bank, your Wells Fargo, even Bank of America was down close towards 40% down. American Express was about the same as well. So that's just looking at financials. It's not even getting into energy stocks, and we'll get a little bit more into that a little bit later. So now what I'm probably doing here is panning over to the income and the capital allocation by sector. This large yellow pie and both of these graphics here is the energy position. So in terms of actual value of the energy position is around 18%, but in terms of income it's around 32%. So it's starting to grow a little bit more as I've continued to purchase these stocks and these energy stocks as the prices have kind of come down a little bit. Financials is still remaining around 16% of the portfolio. That hasn't really changed too much. Real estate's kind of crept down a little bit. I remember at one point it was getting up to 16-17%. Now it's kind of come down to just under 15% in terms of income and as well as capital allocation. So nothing too drastic with that. Everything else is relatively around less than 10%. So consumer staples is just about 10%. Healthcare is about 10% in terms of value in the portfolio. Industrials I'm pretty confident in and have been trying my best to kind of even that out. Companies like Caterpillar, which I just bought, 3M, and actually Virgin Galactic, which doesn't pay a dividend, but it's a spec play. Bought about $1,500 worth of that. So that's in the portfolio as well. So it's relatively small compared to the larger portfolio size. It's less than 0.5%. So some of you guys might jump into the comment section and give me crap about that. But I don't really have a lot of speculative plays in the portfolio, so that was one of them that I really wanted to add. Information technology is around 4%. Cash is around 4.8%. Consumer discretionary is around 2.4%. Bought some GM as well, but I don't think I have that in the stocks we're going to discuss today. Telecommunications a little bit under 7%. Materials is around 3.4%. And I think this has drastically kind of gone down just based off the fact that the value of these companies that I invested in has gone down, not that the fact that I don't have sufficient investment in them. So by the time the value of these kind of go up, I think it'll even out a little bit. That being said, you can see the materials sector provides about 5% of the income. So to kind of give you an idea with that, healthcare is around 7.3%. I think that this is based off of my AbbVie position, but partially offset by the Johnson & Johnson position. So I don't know what Johnson & Johnson's yielding at the moment, but in the past it yields about 2.5%. Before we sort of had these volatile swings in the market here. So AbbVie and J&J kind of even out here to the point where we get around a 3.87% yield by sector. So that's kind of cool to see, is you have some really high yielding companies like AbbVie, and then you have Johnson & Johnson kind of outweighing that. But in combination, we got over 24 grand invested in those particular companies. 6.5% coming from telecommunications, and about 5% or so coming from industrials. Excuse me, industrials. So relatively cool in that respect. Yeah, so I think that that's relatively that part that I want to discuss in the actual portfolio itself, with respect to how everything's kind of split up by sector, and with respect to capital allocation and income. Now I kind of want to give you guys an overview and a quick glance at the positions that I bought in my individual brokerage accounts. This doesn't wholly consist of absolutely everything in here, and I'm not going to show absolutely everything as well because some of this stuff is private. But just to give you an idea as to the majority of the stuff that I bought was in my individual brokerage account. And so actually if I scroll over and show you the overview and scroll down here, the 62% of everything that I bought over the past couple weeks. So I think this is over the last 2 weeks I kind of made as a limit for what I wanted to look back at. There was some stuff I purchased in mid-February, but that was kind of before all this volatility started to come out. So just wanted to look at the last 2 weeks. 62% of that is in an individual brokerage account, and then one big purchase in my computer shares account, which we'll talk about as well. So everything else is rather minor, but it's really just the majority of the purchases in the individual brokerage account. That consists of Caterpillar, which I think I bought like 14 and a half shares of, if you were to combine 14.15 shares at $106. Bryn Mawr Bank Trust, which is around 49 and some change shares, 49 and a half shares, and that was for basically at $30. Bought BP almost at rock bottom at $25 a share. Bought 100 and some shares, so just under 25 or just over $2,500 associated with that purchase. Bought Wells Fargo just to round it off to about 300 shares or so. So I bought about, what is this, 40 some, 42 or so. I have the exact number somewhere, but at about $39 or so, 39.16, 39.07. So around that vicinity. Purchased around 21 shares of US Bank, and we'll kind of get more into that as well. So I bought some partial shares as well, so almost 22 shares there, and I bought that at about $46 on the nose there. So there was that. I sold something which was just minor. I've been holding on to Icon Enterprises forever. Don't really want to talk about it, but on paper I lost money just based off the share price, but I reinvested a lot. So if you were to look at the reinvestments of the dividends and stuff like that, I actually gained on the position, but it wasn't really going anywhere, and I'm probably thankful that I got out before I did, because it's probably down now. I don't even really know what the price is at the moment. Bought about 56 shares of Shell at $44, so we'll talk about how much that's down over the past week or so, and that's kind of the other stuff, is kind of getting into a little bit of what we have in the middle of February, which I don't really want to go into. So that was a decent chunk of what we actually invested in over the past 2 weeks or so. Like I said, it's about 62% in terms of the amount of income. Sorry, 63% in terms of the amount of value that we're investing in the portfolio. 62% of the value is, or the income is, coming from that sector. So overall, we invested about $16,000, and the income coming from that is around $1,100 or so, which ends up being just under $100 a month, which is kind of cool, just from investing over the past 2 weeks. So this, of course, means if nobody cuts the dividend or even raises the dividend, this is what the income is expected to be. But actually looking at a little bit more in depth with what we have here, these are the purchases that I've made, and so I kind of labeled them, said what date I have in here, how many shares, and then we can also see how much I'm down in some of these positions as well. But let's look at specifically like Royal Dutch Shell here. So Royal Dutch Shell, bought it at $44. It's currently at 36, so I'm down on this position a good bit. I'm actually down about 18% or so at the moment, or about 460 bucks. That's fine with me. I don't really necessarily care. What I care about is this annual payout here that is going to be coming out. Keep in mind here, Shell made like $40 to $50 billion in cash flow last year, of which they spent about $25 billion in capex, right? So they were able to put the other money into dividends and share buybacks. That being said, if the price of oil kind of stays here, they're obviously not going to make the $40 to $50 billion in cash flow like they did last year, but I mean, they have sufficient margin to be able to produce a crap ton of cash flow at, I believe, a variety of oil prices. So I'm relatively confident that they'll be fine, and they'll be able to continue to purchase shares and provide dividends to their shareholders as well. US Bank, bought that on the 4th of March, so I bought that about $45. This is also down to about $38 a share, so from that time I'm down 16% in terms of what the actual purchase price that I bought at. That being said, just trying to get the cost down. What I bought the dividend at was about 3.6%. It's actually up to about 4.4%, which is kind of cool. I wish I bought it then. And same with these Shell shares. I bought them at 8.5% yield, and they're up to, I think at one point they hit 11% yield, which is absolutely astonishing. Wanted to do the same with Wells Fargo, purchased about 45 shares or so with Wells Fargo, which I think ended up being about $1,500, $1,600. Did this just to round out to get myself to around 300 shares. For me, I thought 300 shares was kind of cool, so I really wanted to get to that point. But that yields about 5.2% based off of what I invested at, but it's 5.8% in terms of what the actual yield is if you were to invest at the $35, which it's at right now. BP is currently at about $26, which I think is a phenomenal price. It hasn't been this low for the past 10 years. So if you're a follower of BP, I think this is a good entry price. I purchased it below $25, 100 shares or so. I just said, hey, $2,500 in Fidelity, make me some money. And so it did. So up about 7.5%. I'm not really investing in it for the gain. I'm investing in it for the dividends. So that gets me around $250, which ends up being about 20 bucks a month that now I get from BP. So every payout is going to be about $62, which is kind of cool. I'll be definitely collecting that now that I don't really automatically reinvest my dividends. Although with some of these recent dips and some of the financials and energy sector, it's got me thinking if I should just automatically reinvest. But it is what it is for the time being. Purchased around 50 shares of Bryn Mawr Bank Trust. It's a local financial company that I grew up with, in Pennsylvania. For those of you guys that knew that. So I just said, hey, throw $1,500 at it, and basically got myself another $12, $13 a quarter in dividends, so just over $50 or so. It's basically breaking even, so I think I got it at a pretty good price. It's a really well run bank, while it's a relatively small bank as well. How big is it? It's about 600 million at today's prices. So as before all this volatility happened, it's probably $1 billion bank or so. So I'm holding that one for the long term. I think it's either going to get bought out or it's going to be continuing to grow dividends. It's been around since the mid 1800s, and in my local area where I grew up, it continues to expand and do really well. So it's a really affluent area outside of Philadelphia, so it's in a really good area, and I don't think that it's going to go away anytime soon. I think it's going to continue to be a pretty good area to live and a lot of good customer base out there. So I think that's a good long-term hold if you can get in at the right price. Caterpillar, this is one I've been looking at for a while. I know that Bill Gates is really into Caterpillar, and it's one that I've always wanted to kind of enter. I know it was back in the 80s or something in 2016 when we had that brief crash in February 2016, and I really wanted to get in, and I missed the boat, and I've been wanting to get in ever since. And so I just threw $1,400 or $1,500 at it, and was able to walk away with about 14 shares or so and some change. And that ends up being about just under $60 a year, so about a little less than $5 a month in terms of dividend income. So at the moment, based off the share price, I think it's around $106 at the moment, basically breaking even. But that basically rounds out what I invested in the individual brokerage account. Now, I did do some buying in the YouTube Moolah portfolio, so about 6 shares of 3M. And if you kind of roll over to that, basically bought it, at cost at what it is at the moment. But it increases income by about $35, so just under $3 a month if you look at it that way. Was able to get it at about 152, so I wish I was able to get it at 140, but bought this on the 4th, so it is what it is. I think 3M's in a pretty good spot. Way down from all-time highs. I think, what's the all-time high on this bad boy? 219, so we're 30% off of that, and actually got down to 143, which is pretty crazy, and we're already almost 7% up from that point the other day. Purchased some LYB, which is a chemical company here. Been purchasing it for quite some time. I think I purchased it originally in like January, February this year. Continues to go down just based off of the recent oil price that's been dipping. And so yeah, I was able to throw another, what is it, 1,100 bucks at it or so. And I think that was based off of what I'd sold, like a really small position in the Roth IRA. And so I just took that money and invested it in LYB. Purchased it at about just under a 6% yield. It's currently up to about a 7% yield at the moment. So I can't complain with that at all. Pays $1.05 every single quarter. Gets me $65 a year, so just over $5 a month, which it all adds up at the end of the day. But I'm down on this one about 16% compared to why I bought it. But that's fine. I'm not buying it for that. I'm buying it for the income. Um, Short term, might be down, but in the long term, I think it'll be a great purchase. Has a really low price to earnings, so if you're interested in this one, I think it's a really good stock to potentially look at. If you don't have a lot of materials or chemical companies in your portfolio, I think some of the other chemical companies that I looked at were relatively debt ridden, so that's one of the reasons why I stayed very far away from some of those other ones. Now, of course, I couldn't go through the past couple weeks without buying some more Exxon. So at this point, the shares that I have in Exxon are over 200 shares, of which the 94 I just added at about $52 or so. So I wish that I waited a little bit because I think it actually ended up being down to $41 or so in the portfolio. So, or I'm sorry, $40 or so. So it's up about 6% from its all-time lows, which is pretty crazy. But this is a really good company. I have a feeling that it's been pretty capital intensive for them as they try to ramp up Guyana and as they try to ramp up their investments in the Permian. And so I think a lot of folks are looking at that being like, well, where's all this capital going? We're not seeing the returns. And I have a feeling that over the next couple of years, the return on capital is really going to start to really hit home for Exxon. I don't really have any insider knowledge. I don't work for Exxon. Some of you guys might know what company I work for. I'm not going to really publicly advertise it, but I don't work for Exxon. All I know is what I look in the investor reports and what I hear in the office and what I kind of study. I know what they kind of have discovered in Guyana, and I kind of know the position that they have in the Permian. So that being said, I think that they'll definitely have the cash flows coming out over the next couple of years that will really be able to pay back to shareholders, and they have a really good dividend raise over the past couple of years. So yeah, they might have been over capitalizing over the past couple of years, but that over capitalization doesn't mean that they're putting on a lot of debt to be able to do that. I mean, yes, they've pulled out some debt, but comparatively to the other oil companies, they're relatively well leveraged. So no problem with that. 6.5% is what I was able to purchase these shares at, but currently they're at about 8% yield. So if you don't have any at the moment, I think it's a good price. I think over the next couple quarters, once we start to see Guyana really ramp up and the Permian investments really start to ramp up, it'll be fun. I think that'll be partially offset by the fact that the oil price is down a good bit, but I think that that's relatively short term compared to the medium term and long term. Really interesting news just based off this. For those of you guys that know that I work in oil and gas, Exxon and Chevron have both kind of come out and said, hey, we're not really going to follow suit with what BP and Shell is doing. And so what BP and Shell are doing is they're really starting to aim towards carbon neutral energy throughout time to the late 2040s, early 2050s time frame. And so Exxon and Chevron said, hey, we're oil and gas companies. We're going to be that way for a while. So the next couple of years, if you're looking for strictly oil and gas, Exxon and Chevron might be your guys. But I think in the long term, 10 to 15 years plus, you definitely want to be looking at your Shells and your BPs and some of these other companies that are really starting to use their capital to transition to renewables. So although I don't want to go on a huge tangent about oil and gas, but I probably should make a video about it. Not really talking about what the oil price or anything is doing like in the last video I made, but maybe more about what I think the future of energy is in oil and gas. So if you want to see that sort of video, let me know in the comment section down below, and I'll be sure to do that. But like with any of these folks that utilize this tracker, when you put in a stock, it automatically forecasts what your dividends are. And so this 2020 table's already got some partially filled out stuff from dividends that I've received from other companies. So we'll just use the clean slate, which is kind of 2021. And so you can see it automatically fills out this table for you. So you have your Shell, USB, WFC, it kind of just automatically fills this out. So you can kind of get an idea as to what the forecast for your dividends are. A lot of these companies are expected to pay in the March time frame. Only one of them, Caterpillar, is expected to pay in February time frame. So your February's, your May, your August, I think it's August, yeah, and your November time frame. And then only one company, where is it? USB is expected to pay in the um, first, fourth, seventh, and 10th months of the year. So once again, I continue to invest in companies that for some reason pay in the last month of every single quarter. I think that's just most companies pay that way because I think that's when they understand when their dividend is kind of safe or what they can pay out every single quarter. Um, but hey, it is what it is. But I think the cool thing is that you can actually see here is some of these purchases are relatively good for the bottom line. I mean, yeah, we're walking away with around $1,100 or so in forward dividend income, but Shell is supposed to be paying me another $212 a year. BP is going to be paying me another $250 a year. Exxon's going to be paying me another $330 a year. This chemical company is going to be paying me 65. 3M's going to be paying me 35. Caterpillar's going to be paying me just under 60. Bryn Mawr Bank's going to be paying me just over 50. Wells Fargo is just under $100, and then U.S. Bank is just over $36. So turns out to be pretty cool. And for the third month of every quarter, it ends up bumping up my income by about another $250 that month. So that is pretty cool. I mean, I can't complain with that. We're looking at adding just under like 90 or so dollars. I think it was like $92 every single month or so. So $94 or so every single month in terms of average income that I should be expecting. So that's pretty cool. I mean, I can't, not be excited about getting another $94 a month. I mean, if you think about it, that's probably like, a good portion of some people's grocery bills, or that's like a one wild night out for me every single month if I go out. I mean, generally spend a little bit less than $90 if I go out like wild. Um, but I mean, sometimes some nights are a little bit more than that. Um, but that being said, I mean, I think this is a really good opportunity to purchase some stocks if you're buying the right ones. So just make sure, don't obviously take everything that I bought and be like, hey, Matt Money bought it, I should buy it as well. Do your own due diligence, please, and make sure it's something that you're comfortable investing in, whether it's your risk tolerance, whether it's, your debt tolerance that you might have for specific companies. So I'm very energy focused with respect to my portfolio. It's because I work in the energy sector as well. So that might be my bias kind of kicking in, saying, hey, I know this company. I work with these guys. I've worked with this company. I've worked with that company. I know what they're doing. I should invest. That could be my personal bias. And, energy stocks might not be for you. That some of them, you know, are relatively high in debt. So that being said, investing in oil ETFs is something I would definitely steer away from, because think about it, you might be trying to get exposure across Shell, BP, Exxon, Chevron, Total, some of these very large companies, but in the background you're investing in some real dog of companies, like, not to put it into true spotlight here, but let's just say Occidental, that has $35 billion worth of debt, and currently the company is only worth about $12 billion on the free market. So, not to say that I wouldn't buy Oxy. I don't know too much, and I haven't looked too much into it. But that being said, I think that a lot of people just say, "Oh, well, oil's down, so let me invest in oil ETFs," and not a one size fits all sort of thing. I mean, just like you wouldn't want to buy like a healthcare, only if you're investing in specifically like high risk biotech companies that are like, hey, we're going to invest in this one drug and spend all of our money on this one drug, and if it works out, you know what I mean? So just be wary of where your risk is being put. And some of these ETFs, sometimes they're really good. I mean, sometimes you could be like, okay, well, I only want to invest in healthcare ETFs for companies in the S&P 500. So, they're kind of vetted. They have the income coming in. They have relatively good debt to equity ratios. But if you're investing in like all around healthcare fund, I mean, you can get some real garbage. Just like if you're to invest in industrials, if you're to invest in, consumer staples or technology, I mean, you're investing in any of these companies that fit under those sectors when you're investing in those ETFs. So just be cautious in this sort of market and or any market even of what you're investing in. I think a lot of people just say, well, ETFs are the way to go, so I'm just going to put my money in ETFs. You do have to think a little bit, guys. And so, it's only going to help you in the long run. The more you feed the business or you feed the portfolio, the more it's going to help you. But it's all about what you're feeding it and where you're putting your money. I mean, if it's all about cost benefit analysis and making sure that you're making the right decisions for your portfolio, for your risk tolerance, and for your time horizon. So, anyway, I'm gonna cut this one off and edit it, and hopefully get it up for you guys. Hopefully, a few of you guys will watch it before it hits midnight here. And I'll see you guys on the next one. Cheers.